accounting standards and practices. For the interest of customers, investors, owners, it is necessary that financial statement of a company should be transparent, properly disclosed, consistent, and reliable. For this purpose, accounting standards are framed by ICAI in India. There are many users of financial statements as investors, creditors, government, consumers, owners, etc. They take many economic decisions on the basis of financial statements. If the financial statements are not properly regulated, there is a possibility that the financial statement may mislead and provide the distorted picture of the business in the place of a true and fair picture of the business. Proper regulation of the process of accounting, it is essential so that these statements should be transparent, properly disclosed, consistent, and reliable. Adequate disclosure in the accounts is also required. For this purpose, accounting standards are prepared at the national and international level. Actually, the generally accepted accounting principles are codified by accounting standards. Accounting standards prepare the norms and guidelines to prepare the financial statements, and annual reports prepares the norms and guidelines to prepare the financial statements and annual reports. At the international level, the International Accounting Standard Committee, IASC, has issued the international standards. In this committee, there are leading professional bodies of UK, USA, Australia, France, and Canada. India is also a member of this committee. India has also prepared its own accounting standards, which are prepared by the Institute of Chartered Accountants of India. This lesson discusses about various accounting standards. It follows from the previous slide that after studying this lesson, you should be able to understand the meaning and need of accounting standards, understand the creative financial practices, understand the issues relating to the quality of disclosure of reported profits. AS1 deals with the disclosure of significant accounting policies followed in preparing and presenting financial statements. The purpose of AS1 is to promote better understanding of financial statements by establishing through an accounting standard the disclosure of significant accounting policies and the manner in which accounting policies are disclosed in the financial statement. Such disclosure would also facilitate a more meaningful comparison between financial statements of different enterprises. Certain fundamental accounting assumptions underlie the preparation and presentation of financial statements. They are usually not specifically stated because their acceptance and use are assumed. Disclosure is necessary if they are not followed. Generally accepted fundamental accounting assumptions include going concern concept, consistency, and accrual. The accounting policy refers to the special accounting principles and the method of applying those principles adopted by the enterprise in the preparation and presentation of financial statements. There is no single list of accounting policies which are applicable to all circumstances. The differing circumstances in which enterprises operate in a situation of diverse and complex economic activity make alternative accounting principles and methods of applying those principles acceptable. The primary consideration in the selection of accounting policies by any enterprise is that the financial statement prepared and presented on the basis of such accounting policies should represent a true and fair view of the state of affairs of the enterprise, as at the balance sheet date and profit and loss for the period ended on that date. For this purpose, the major considerations governing the selection and application of accounting policies are prudence, substance over form, and materiality. AS1 says that all significant accounting policies adopted in the preparation and presentation of financial statements should be disclosed. The disclosure of the significant accounting policies as such should form a part of financial statements, and the significant accounting policy should normally be disclosed in one place. Any change in the accounting policy which has a material effect in the current period or which is reasonably expected to have a material effect in later periods should be disclosed. The revised standard supersedes accounting standards AS2. Valuation of inventories issued in June 1981. It came into effect in respect of accounting periods commencing on or after 1st of the 4th, 1999. And is mandatory in nature. A primary issue in accounting for inventories is the determination of the value at which inventories are carried in the financial statements until the related revenues are reckoned. This statement should be applied in accounting for inventories other than the work in progress, arising under construction contracts, including directly related service contracts, work in progress arising in the ordinary course of business of service providers, shares, debentures, and other financial instruments held as stock in trade, and producers' inventories of livestock, agriculture, and forest products. and mineral oils, ores, and gases to the extent that they are measured at net realizable value in accordance with well-established practices in those industries. Inventory should be valued at the lower of cost and net realizable value. The cost of inventories should comprise all cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. The cost of inventories of items that are not ordinarily interchangeable and goods or services produced and segregated for specific projects should be assigned by specific identification of their individual costs. Specific identification of cost means that specific costs are attributed to identified items of inventory. This is an appropriate treatment for items that are segregated for a specific project, regardless of whether they have been purchased or produced. Techniques for measurement of the cost of inventory, such as the standard cost method or the retail method, may be used for convenience. If the results approximate the actual cost, standard costs take into account normal level of consumption of materials and supplies labor efficiency and capacity utilization. They are regularly reviewed and, if necessary, revised in the light of current. AS6 deals with the depreciation accounting and applies to all depreciable assets, except forests, plantations, and similar regenerative natural resources. Wasting assets include expenditure on the exploration for and extraction of minerals, oils, natural gases, and similar non-regenerative resources, expenditure on research and development, goodwill, livestock. This statement also does not apply to land unless it has a limited useful life for the enterprise. According to AS6, depreciation is a measure of the wearing out, consumption, or other loss of value of depreciable assets arising from use, effluxion of time, or obsolescence through technology and market changes. Depreciable assets are assets which are expected to be used during more than one accounting period and have a limited useful life, and are held by an enterprise for use in the production or supply of goods and services, for rental to others, or for administrative purposes, and not for the purpose of sale in the ordinary course of business. Depreciable amount of a depreciable asset is its historical cost, or other amount substituted for historical cost in financial statements, less the estimated residual value. Depreciation has a significant effect in determining and presenting the financial position and results of operating of an enterprise. Depreciation is charged in each accounting period by reference to the extent of the depreciable amount, irrespective of an increase in the market value of the assets. Assessment of depreciation and the amount to be charged in respect thereof in an accounting period are usually based on the following three factors: historical cost or other amount substituted for the historical cost of depreciable asset when the asset has been revalued, expected useful life of the depreciable asset, and estimated residual value of the depreciable asset. The depreciation method used: the most depreciation for the period for each class of assets. The gross amount of each class of depreciable assets and related to accumulated depreciation are disclosed in financial statements along with the disclosure of other accounting policies. The depreciation rates or the useful life of the assets are disclosed only if they are. Statement deals with the basis for recognition of revenue in the statement of profit and loss of an enterprise. The statement is concerned with the recognition of revenue arising in the course of the ordinary activities of the enterprise from the sale of goods, rendering of services, and the use by others of enterprise resource yielding interests, royalties, and dividends. The statement does not deal with revenues arising from construction contracts, revenue arising from hire purchase lease agreement, revenue arising from government grants and other similar subsidies, revenue of insurance companies arising from insurance contracts. According to this statement, revenue is the gross inflow of cash. Receivables or other considerations arising in the course of ordinary activities of an enterprise from the sale of goods, from the rendering of services, and from the use by others of enterprise resources yielding interests, royalties, and dividends. Revenue is measured by the charges made to customers or clients for goods supplied and services rendered to them, and by charges and rewards arising from the use of resources by them. Completed service contract method is a method of accounting which recognizes revenue in the statement of profit and loss only when the rendering of services under a contract is completed or substantially completed. Proportionate completion method is a method of accounting which recognizes revenue in the statement of profit and loss proportionately with the degree of completion of services under a contract. Revenue recognition is mainly concerned with the timing of recognition of revenue in the statement of profit and loss of an enterprise. The amount of revenue arising on a transaction is usually determined by agreement between the parties involved in the transaction. Recognition of revenue requires that revenue is measurable and that at the time of sale or the rendering of services, it would not be unreasonable to expect ultimate collection. Where the ability to assess the ultimate collection with reasonable certainty is lacking at the time of raising any claim, example, for escalation of price, export incentives, interest, etc. Revenue recognition is postponed to the extent of uncertainty involved. In addition to the disclosures required by Accounting Standard 1 on disclosure of accounting policies, AS1, an enterprise should also disclose the circumstances in which revenue recognition has been postponed, pending the resolution of significant financial statements disclose certain information relating to fixed assets. In many enterprises, these assets grouped into various categories such as land, buildings, plant and machinery, vehicles, furniture and fitting, goodwill, patents, trademarks and designs. AS10 does not deal with specialized aspects of accounting for fixed assets that arise under a comprehensive system, reflecting the effect of changing prices, but applies to financial statements prepared on historical cost basis. According to it, fixed asset is an asset held with the intention of being used for the purpose of producing or providing goods or services, and is not held for sale in the normal course of business. Fair market value is the price that would be agreed in an open and unrestricted market between knowledgeable and willing parties dealing at arm's length, who are fully informed and are not under any compulsion to transact. Gross book value of a fixed asset is its historical cost or other amount substituted for historical cost in the book of accounts or financial statement. Fixed assets often comprise a significant portion of total asset of an enterprise and therefore are important in the presentation of financial position. Furthermore, the determination of whether an expenditure represents an asset or an expense can have material effect on an enterprise's reported results of operation. The definition in paragraph 6.1 gives criteria determining whether items are to be classified as fixed assets. Judgment is required in applying the criteria to specific circumstances or specific type of enterprise. It may be appropriate to aggregate individually significant items and to apply the criteria in the aggregate value. An enterprise may decide to expense an item which could otherwise have been included as fixed asset, because the amount of expenditure is not material. The cost of an item of fixed asset comprises its purchase price, including import duties and other non-refundable taxes or levies, and any directly attributable cost of bringing the asset to its working condition for its intended use. Any trade discount and rebates are deducted in arriving at the purchase price. Financing costs relating to deferred credits or to borrowed funds attributable to construction or acquisition of fixed assets for the period up to the completion of construction or acquisition of fixed assets are also sometimes included in the gross book value of the assets to which they relate. Administration and other general overhead expenses are usually excluded from the cost of fixed assets because they do not relate to a AS13 deals with accounting for investments in the financial statement of enterprise and related disclosure requirements. According to this statement, investments are assets held by an enterprise for earning income by way of dividends, interest, and rentals, for capital appreciation, or for other benefits to the investing enterprise. A current investment is in
According to AS17, segment reporting issued by the Council of Institute of Chartered Accountants of India, this standard comes into effect in respect of accounting periods commencing on or after 1/4/2001 and is mandatory in nature from that date in respect of 1. Enterprise whose equity or debt securities are listed on a recognized stock exchange in India, and enterprises that are in process of carrying equity or debt securities that will be listed on recognized stock exchange in India, as evidenced by the Board of Directors resolution in this regard. All other commercial, industrial and business reporting enterprise whose turnover for the accounting period exceeds ₹50 crores. The objective of this statement is to establish principles for reporting financial information about the different type of products and services an enterprise produces and different geographical areas in which it operates. This statement should be applied in presenting general purpose financial statements. The requirements of this statement are also applicable in case of consolidated financial statements. The dominant source and nature of risks and returns of an enterprise should govern whether its primary segment reporting format will be business segments or geographical segments. If the risks and returns of an enterprise are affected predominantly by differences in the product and services it produces, its primary format for reporting segment information should be business segments, with secondary information reported geographically. Business and geographical segments of an enterprise for external reporting purposes should be those organizational units for which information is reported to the Board of Directors and to the Chief Executive Officer for the purpose of evaluating the unit's performance and for making decisions about future allocation of resources. In measuring and reporting segment revenue from transactions with other segments, inter-segment transfers should be measured on the basis that enterprise actually used to price those transfers. The basis of pricing inter-segment transfers and any change therein should be disclosed in the financial statement. Now let us check if we have understood the various concepts discussed in this lesson clearly. Depreciable assets are assets which are expected to be used during less than one accounting period. Right or wrong? Please click. Wrong. Completed services contract method is a method of accounting which recognizes revenues in the statement of profit and loss only when rendering of services under a contract is completed or substantially completed. Right or wrong? Please click. Right. Floating asset is an asset held with intentions of being used for the purpose of producing or providing goods or services and is not held for sale in the normal course of business. Right or wrong? Please click. Wrong. Before we end, let us briefly revise what we've studied till so far. For the purpose of regulation of a process of accounting, transparency, disclosure, consistency and reliability, accounting standards are prepared by Institute of Chartered Accountants of India, ICAI. There is a creative practice to disclose the following information along with the balance sheet and profit and loss account of the company. A. Summarized form of P&L account and balance sheet. B. Highlights. C. Disclosure of accounting practices. D. Charts, graphs and diagrams. E. Important ratios. F. Impact of price level changes. G. Statement of sources and uses of funds. H. Uses of schedules. I. Rounding of figures. J. Human resource activities.